While doing theoretical studies of the discipline investment banking, you will definitely land at a very important module on what risk is, different types of financial risks, how to manage it, and different rules set by international bodies to remove the financial and investment related risks out of the equation. Today, with this particular video, we are comprehensively going to understand the initial two parts of financial and investment risk. But before we dive into the concept, please ensure subscribing to the Intellipaat YouTube channel so that you won't miss out on any updates coming from our team. Having said that, let's get started.
Meaning and definition of a risk. So guys, all of us know what a risk is, right? Basically, it is the phenomena where we do things even if we sense danger. It is a situation where there is possibility of losing something of value. In this slide, the risk has been summed up very nicely with this particular statement that a risk is intentional interaction with uncertainty. Basically, what it means is we intentionally do things wrongfully, which at the end of the day results in some sort of loss. Simply guys, risk is the chance that something bad will happen. And it is always important to be aware of the risks involved in any decision or action so that you can make informed choices and take steps to mitigate the risk. There are many and different types of risk, including financial risk, physical risk, reputational risk, and operational risk. So guys, financial risk is the risk where you'll lose the money, whereas physical risk is the risk where you'll be injured or your property might be damaged. Reputation risk is the risk where your reputation will be tarnished, and operation risk is something where disruption of your business operations will happen. And all of these are basically very simple and different types of risk. And in order to battle all these risks, you need a proper risk management mechanism. Risk management in its very basic sense is the process of identifying, assessing, and controlling risk. Let me reiterate this definition again. So guys, risk management is the process of identifying, assessing, and controlling risk. So here, first of all, what you'll be trying to do is you'll be identifying from where the risk can arise. After that, you'll assess the risk. And finally, you'll try to do some controlling measures to avoid the mishap that could happen because of that particular risk. Now, this can involve developing policies and procedures, implementing risk controls, and purchasing insurance. For example, if you have a vehicle and you want to, if you have a vehicle and you don't want to indulge into accident, mayhem situations, then probably what you'll do is you'll buy an insurance for your vehicle, and if your vehicle goes to some sort of breakdown, then insurance company will provide the finances for it. So basically, this is how you mitigate a very simple risk phenomena where accident could cost you huge finances, right? Now, let us move towards the next slide. So, initially, I mentioned that risk or threat could emerge from various sources such as financial uncertainties, legal liabilities, strategic management errors, or even accidental or natural disasters, right? The example of financial uncertainty could be economic downfall or recession. The example of this could be the recent economic downfall that we witnessed in 2023 in United Kingdom. The policies that government implied, a lot of internal scams that happened internally, the impact of Brexit law and all created economic turmoil in the United Kingdom. And nobody could predict these things early hand, right? We saw Boris Johnson removed from the presidential seat, right? So this is how these things could be impactful and you won't even notice them happening in the background. That's why this is termed as uncertainty related to finance. Now, in similar manner, legal liability and all other contributors can create a threat or risk that could destroy financial stability for a person, organization, or even nation, right? Now, guys, the example of legal liability could be the Adani Group and Hindenburg Research Organization's battle. So, Hindenburg Research Organization posted that Adani Group is doing a lot of scam with their 8 child companies, and that led to loss of rupees 85 crore in value. Now, both of these organizations are fighting legal battle against each other. So this is sort of a legal liability. And there is accident and natural disaster. All of us went through COVID pandemic, and during that time, we saw a lot of businesses going bankrupt. And the reason behind that is natural calamity like COVID, right? Or there could be a flood situation where businesses will be completely wiped out. So these could be accidental and natural disasters that could lead to massive risk, right? Now let us move to the next slide. In order to mitigate the risk that we talked about, it is very important to have risk management mechanism in the place of business setting. Now guys, you can think of risk management as a way business decide on the type and amount of risk they are okay with. I want you to understand this statement very clearly. See, in the case of business, there is no 100% guaranteed way that a certain effort will turn into a success. So definitely there will be a certain degree of risk involved with every financial effort. But it's necessary to decide if an organization could take that risk or not. See, when companies make decisions, they often have to use their current resources with the hope of making more in the future. But it's not guaranteed. This decision making and dealing with uncertainties are what we call taking risk. Now imagine this like a coin. Taking risk and managing them are like two different sides of the same coin. For a business to do well, the people in charge need to be good at deciding how much risk is worth the potential reward. It's like playing a game where you have to figure out what risks are okay to take. Successful organizations are like experts at playing this game. They build their ways of making decisions around figuring out how much risk is okay when compared to what they might gain. It's like finding the right balance between taking out chances and making sure everything works out well for the business. I mean, for sure, definitely without risk, you cannot win big rewards, right? And in order to make each and every business decision, there is going to be certain degree of risk associated with it. But it is the sole responsibility of board members of that organization to understand how much risk they could take and how much benefit they would gain from it, right? Now, I just mentioned, I hope this is pretty clear to you guys. Now, as I just mentioned that businesses have to identify the type of risk and amount of risk they could take, right? So let us talk about the types of risk factor in detail here. So the risk types that you see here on your screens are basically the different risks that are involved in a business setting. Now, first one you could see is market risk, there is credit risk, liquidity risk, operational risk, legal and regulatory risk, business risk, strategic risk, and reputational risk. First of all, let us talk about market risk in detail. So guys, market risk is the chance that the value of things in the financial market, like stocks or investments, might go down and affect how much they are worth. This can happen because of changes in market prices and rates. Now, when we talk about risk related to price of something, we can break it down into two parts. First one is general market risk component, and second one is specific market risk component. So general market risk component is kind of the risk that is subjected to the market itself. I mean, if you are a part of market, definitely you'll face this risk with everyone else who is part of the market. It is kind of like how the overall weather might impact everyone in a city. So this is a very generic kind of and one-to-all kind of risk. Then there is specific market risk component. This is more specific kind of risk. It's unique to the particular financial transaction we are thinking about. It's like saying, okay, for this specific thing we are dealing with, here are the risks that are existential. In simple terms, market risk is the chance that the value of what you have might go down because of changes in the financial market. And it has these two parts, general and specific risk. In trading, you also have to watch out for risk when you don't have protection or when you move or when your moves don't perfectly balance each other. Let us talk about market risk classifications. Basically, the things that we are going to discuss now could contribute to the market risk that we just defined in a previous slide. So, first one is interest rate risk. Interest rate risk is like the chance that the value of something called a fixed income security might go down. Now, fixed income securities are like investments where you get a set up amount of money back over time. The risk here is that if the interest rate in the market go up, the value of these securities might go down. It's a bit like if interest rate rises, the worth of what you invested might not be as much. Now let me give you a very simple example to help you visualize what exactly interest rate risk is. Now imagine that you have decided to invest a fixed income security like a bond which promises to pay you a certain interest rate. Now when you made this investment, let's say the market interest rate were at 3%. A few years later, the economy starts doing really well and central bank decides to increase interest rate to control the inflation amount. Now the new market interest rate are 5%. Here is where your interest rate risk comes in because your bond is locked into the old interest rate of 3%. New bonds in the market are offering a higher interest rate at 5%. People might find these new bonds more attractive because they offer a better return. As a result, the value of your bond in the market may fall because it's not as competitive as the newer ones with the higher interest rate. If you had to sell your bond before it matures, you might not get as much money for it as you initially invested. So it is very simple, guys. So for example, if I have invested 10,000 rupees in bond and if I was about to get 3% interest rate, right? And the maturity amount is, let's say, 2 years down the line. But now, since the interest rate in the market has been increased, so there are few services which are offering 5% interest rate, or there are few bonds that are offering 8% interest rate. So in those particular cases, obviously, I'll be losing out on value that my initial bond had, right? So this is what we call as interest rate risk. After that comes equity price risk. Now let's talk about equity price risk. This is the risk that comes with the ups and downs of stock prices. Equity price risk is when the value of your stocks go up and down because of the whole stock market is moving. So if the market goes crazy and start shaking a lot, your particular stock will go in the very same direction, right? I mean, we discussed about recession in UK earlier. So when prices of daily commodities go down, people start losing their jobs. The banks have to increase or decrease the interest rates. Then the equity price risk happens. Market fluctuates and with it, your stock pricing does as well. And this is what in a silo equity price risk is. Now next we have is foreign exchange risk. So guys, foreign exchange risk, often known as currency risk, is the potential for financial loss due to change in exchange rates between different currencies. Now, when a company or individual engages in transaction involving multiple currencies, they face the risk that the value of one currency relative to another may fluctuate. I mean, we see on a daily basis, the amount of USD against rupees keeps on fluctuating. So that is what we consider as foreign exchange risk. Now let me give you a real life scenario. Now let me give you a very simple example of this kind of risk. Suppose, let's say, a company based in United States does a business in Europe. They generate revenue in euros since they are operating Europe, right? But the reporting and operational costs are primarily based out of US dollars. Now imagine that the euro weakens against US dollars due to economic factors or geopolitical events. When the company converts its euros now imagine that the euro weakens against US dollar due to economic factors or geopolitical events. Now when the company will convert its euros back into dollars, they'll receive fewer amounts of dollars than they initially expected, right? This is what we call currency fluctuation, and it can definitely result into financial loss for the company, and it could impact the overall profitability or revenue of an organization. Many companies have faced foreign exchange losses in the past as currencies experience significant volatility. For instance, a US-based company conducting business in Europe might have encountered challenges when converting their euro earnings back into dollars if the euro depreciated against the US dollar. So if we talk about 2023, June and March period, at that time we saw that UK went through a recession, a big financial setback. And at that time, the value of euro against dollar depreciated. And during that time, if company which is operating in UK and those operational charges are mentioned via USA channel, then definitely they must have seen dip in the currency value, right? And this shows that foreign exchange risk could be a detrimental impact on a currency market. Now, next we have is commodity price risk. Guys, commodity price risk is the chance that the price of goods or raw materials known as commodities may change and affect businesses or individuals who use or trade these commodities. Now, this risk arises because commodity prices can be influenced by various factors like supply and demand, geopolitical events, and economic conditions. Now, real-life example could be oil price fluctuations that happened in 2020 when the COVID-19 pandemic led to a significant drop in global oil prices. With lockdowns and travel restrictions, the demand for oil went down as people traveled less and industries also slowed down. As a result, the oversupply of oil led to a dramatic fall of oil prices. This created challenges for oil-producing countries and companies heavily dependent on oil revenues. They faced the risk of reduced income and financial strain due to the unexpected and rapid decline in commodity prices. Businesses that were heavily resilient on oil-related activities, such as transportation companies and those in energy sector, experienced the impact of commodity prices. This event highlighted how external factors can lead to substantial fluctuations in the commodity prices, affecting various industries and economies worldwide. So that's what commodity price risk is all about. Now moving forward, let us talk about the second type of risk on our list, that is a credit risk. Guys, a credit risk is the chance that a borrower might not repay a loan or meet their financial obligations, causing financial loss to the lender. So in this case, for example, let's say a certain bank gives loan of 10 lakh rupees to its customer, and then the customer defaults on that loan. In that case, a bank will be losing out on a lot of money, right? Because borrower failed to fulfill the terms of loan repayment, right? Now, let us consider the example of credit risk. The prime example of this could be the mortgage crisis of 2008, right? During this period, financial institutions provided home loans to borrowers with poor credit histories as well. That's why during 2008, financial institutions or banks in United States provided home loans to borrowers who even had poor credit histories. and these people were termed as subprime borrowers. These loans were bundled together and sold as mortgage-backed securities to investors. As housing prices declined, many of these subprime borrowers struggled to make their mortgage payments, leading to a surge in loan defaults. The mortgage-backed securities, once considered safe investment, lost value as a result. This widespread failure of borrowers to meet their repayment obligation resulted in significant financial losses for banks and other financial institutions. And this contributed to the global financial crisis in 2008, which is famously known as mortgage crisis, right? In this case, the credit risk stemmed from the high number of subprime borrowers who were unable to repay their loans, causing ripple effect across the financial system. Now moving on to the next slide, let us talk about liquidity risk part. So when we say about liquidity risk, what do we understand by liquidity risk? In simple word, there are two types of liquidity risk. One is called funding liquidity risk and other one is called as trading liquidity risk. Alright, in simple word, if I have started a business and I need funds in regular intervals, but I'm unable to get those funds. In those situations, that kind of risk will be called as funding liquidity risk, right? So I'll be requiring two kind of loans. One could be a short-term requirement and another one could be a long-term requirement. For example, I need to set up a plant, buy a land and buy a lot of machineries to run my business. And to fulfill that long-term loan, if I'm unable to raise the cash, then definitely that kind of business risk is called as funding liquidity risk. Now, an example of this could be Adani Group's recent example, right? So basically in 2023, a Hindenburg report came out in the market and a lot of banks became reluctant to release loans to Adani Group because their reputation was tarnished, right? And that is what is called as funding liquidity risk. So Adani Group was unable to produce more amount of money in order to fund their new initiatives. So that is what a funding liquidity risk is. And funding liquidity risk basically relates to three factors. First one is raising the necessary cash to roll over its debt. So if a company is unable to generate more cash, if they are unable to raise the capital, then definitely they'll feel this funding liquidity risk. Like we talked about Adani's example. Now there could be meet the cash margin and collateral requirement of counterparties and satisfy capital withdrawals as well. So when we talk about collateral, what collateral basically means is it is a security that you give to a financial organization. For example, if I were to get a loan, then in that case, I need to mortgage my house, right? So that is a kind of security thingy that I'm giving to the bank in return for money. And if the value of that collateral goes down, then I need to provide multiple collateral assets. For example, if I have given my house as a collateral and now its value has been depreciated, in that case, I have to provide an additional collateral to the bank. So that is what we call a collateral requirement. All right. Now this funding liquidity risk can be managed through holding cash and cash equivalents, setting credit line in place and monitoring buying power. So what exactly this buying power is? Guys, buying power refers to the amount a trading counterparty can borrow against assets under stress market condition. So stress market conditions means what? Whenever interest rates go up or when the bank does not have sufficient fund or there is a liquidity type situation in the market, in that particular situation, if you want to raise the fund, then if you have more assets, then against those assets, basically you can raise more money. If you don't have significant assets, then raising the money becomes more difficult. So basically, let us say that if I have two houses, one of my house is basically, let us say, loan-free house. Now there is no mortgage or no loan on that particular house. And I am in some emergency or I'm thinking to start a particular business venture and I do not have any other collateral to provide. I can simply say that I can give one of my houses as a collateral to the bank, which is nothing but mortgaging my house and take a particular business loan. So here, when we are mortgaging the house, we are not taking house loan. We are taking a business loan against the house. So this is like if you have generated assets over a period of time, those assets can be utilized even for taking the loan because these assets act as a collateral in this particular time. So that is the reason that you should keep on generating the asset as an individual investor. Also, let us say that you have invested in certain mutual fund unit or you have bought certain equity share. And let us say over a period of time, a person has 50 lakh worth of share and you need 10 lakh in some emergency against this particular mutual fund itself. You can easily create 10 lakh in that situation. So basically, you're not going and just getting the 10 lakh in a very blank manner or without any particular security. You're keeping that particular mutual fund as security with someone. You're keeping that particular mutual fund as security with someone and you're getting a loan against that. What is the advantage? So from borrower's point of view, whenever you offer security, the interest rates come down dramatically. If you do not offer sufficient security or if the quality of the security is not good, in that case, the interest rate will go up. That is the reason houses are considered to be the most authentic security, and that is the reason why the housing loan interest rates are substantially lower in India. That point you always have to keep in your mind because this is something what resonates the power of liquidity risk. All right, and how you can mitigate it with other assets that you might hold with yourself, right? Now let's move on to the next slide, which is going to be legal and regulatory risk. So guys, legal and regulatory risk simply means that whenever the law changes, whenever the regulatory changes something, ultimately that creates a risk for the business also. So just for an example, consider this hypothetical situation where government puts a ban on manufacturing all of the diesel cars. If this particular law comes, just assume if this particular law comes, all the car companies which has recently set up new car manufacturing unit of diesel car, you can understand that investment will go for a loss. That investment will be a wasteful expenditure for them. So guys, legal risk or regulatory risk ultimately poses a lot of danger for the business. Guys, in a very basic sense, regulatory risk is like the uncertainty and challenge a business might face due to laws and rules. Alright, and it is quite tied to how the business operates and its reputation. Now, what could be the reason for legal and regulatory risk? Now, there could be multiple reasons, but mostly they'll be linked to how a business runs its operation and how it's perceived by the authorities and the public. If the company doesn't follow the laws or regulation, it can face problems. Alright, so for example, if government has banned a production of, let's say, nicotine, then in that cases, all the tobacco companies will go bankrupt and they'll face a lot of legal and regulatory risk. So this is a kind of stage where company is not following the regulations and laws that are set by government. Alright, this was just an hypothetical example. It's not really happening in India right now, but just for sake of viewing how legal and regulatory risk could impact, we considered it. Alright, now there could be another problem that can cause this kind of risk, and it will be related to the generic opinion of public about your company. Alright, if people think that this particular company is not operating well, if they have not providing value to the customers, then definitely a negative mass opinion will be created against your company, and which could again lead to a lot of legal activities and regulatory turmoil. Now, another reason for legal and regulatory risk could be counterparty authority and dangerous transaction. Sometimes the risk comes from dealing with someone who might not have a proper legal or regulatory permissions for a risky transaction. It's like doing something dangerous with someone who is not allowed to do it. For example, let's say organization A has been banned to do this kind of transaction by government, and still if organization B does that kind of transaction with organization A, then of course there will be some sort of legal repercussions for organization B as well. And under the Basel II Accord, which is like the set of rules for banks, legal and regulatory risk, and you can read the third pointer here, which says under Basel II Capital Accord, legal and regulatory risk are categorized as operational risk itself. So these risks are put under operational risk. What means it is basically related to how business operates and what people think about the business, right? Now let's come down to the final pointer on this slide, which is when a counterparty or investor loses money on a transaction and decides to sue the provider firm to avoid fulfilling its obligations. Legal problems in these kind of situations in derivative markets frequently can surface in longer time, right? So in certain markets like derivative markets, legal problems can show up late. For example, if a party loses money in a deal and decides to sue this other company, it can take time for legal troubles to become apparent. This is like delayed reaction to financial losses. In simple terms, legal and regulatory risk is about challenges a business faces because of laws and rules that has been set by authorities, government, and the banking institutions. It's connected to how the business operates and how people see it. Sometimes it can be risky to do transaction with someone who might not have the right permissions, and under certain rules for banks, legal and regulatory risk are considered part of how a business manages its overall operations. Now let us move to the next slide. Here we can see that the possible impact of change in tax law on the market value of a position is another facet of regulatory risk. It's another facet of regulatory risk. So basically guys, if the taxation law changes in particular country, then definitely that could impact business in negative way. Now, to give you some sort of similar example, I would say, let's imagine that you own a fancy car. Now, imagine that a government of your country comes out saying that fancy cars will be taxed extra. Now, this new rule could make your car less valuable, right? That is similar to how changes in tax laws can affect the financial world. Big banks and companies make decisions based on the current rules. When the rule change, it can mess up their plans and make their investment less valuable. Just like your fancy car losing value, they could lose money. This is what called as regulatory risk factor. Now think back to 1997 in England. The government changed the tax code and suddenly a special tax benefit that banks relied on disappeared. This was like a surprise tax increase for these banks and it caused them big losses. So just like you would be careful about buying a fancy car if you know tax rules might change, banks need to be careful about their investments because of the certain regulatory risk. So in a silo, that's what legal and regulatory risk is and how you can mitigate it. Now let's move to the next slide and talk about business risk. So guys, business risk involves the classic uncertainties that businesses face in their daily operations. These uncertainties revolve around key aspects like demand for product, price that can be charged for those products, the cost of producing and delivering those products. Now let us first talk about demand for products. So businesses are always uncertain about how much people will want to buy their product. It's like not knowing for sure how popular a new phone or clothing line will be. For example, let's say there is this new phone company in market which is known as Nothing Phone, and they come up with new phone idea which is again a mimicry of iPhone and people don't actually like it. In that case, the demand for product will be very, very less and they won't be able to know what masses are thinking about their product until and unless their product is rolled out. So this is a kind of business risk. And this is totally related to how a business operates. So in this particular case, what business should do is they should produce less devices and once the sales are higher, they can produce another lot of it, right? Now, next one is businesses can charge money for their products, definitely, right? And market conditions, competitions, and customer preferences can influence how much people are willing to pay for their product. And it's akin to restaurants not being sure how much customers are willing to pay for a new dish. Now, the second factor is price that can be charged for those products. Now, we just talked about Nothing Phone's example. So, if they have launched a product and people are not willing to pay more than 30,000 for an Android phone, in that case, if they have set of value for 40,000, then people would be not going to buy their phones. The reason being is value is on a higher side. So that's why they have to place their product in such a pricing range that people would be able to buy it, and the psychology of mass will relate with the pricing, right? And another thing will be the cost of producing and delivering products. So in case of Nothing Phones example, they of course will have to produce phones, and they will need a delivery mechanism to get those phones to their customers. And all those things also requires a cost. And their pricing should be in a way that it covers all of these factors. If they are unable to cover it, then the business will never be able to produce profits, and it will go and suffer heavy losses. So this is what in a silo business risk is. Now, let's talk about strategic risk. So guys, strategic risk is like the danger a company faces when making big investments where the outcome is highly uncertain regarding success and profitability. So if I were to decode strategic risk in very simple words to you, then I'll take that simple and intuitive Nothing Phones example. So now this company has come up with a new product range and they have launched the product. And at the same time, they have invested a lot of money in producing this product. But they don't know if this product will work out or not, because it is merely going to be a copy of iPhone in Android format. So definitely mass would not think such highly of it. In that case, definitely this could be a big strategic risk for a business. All right. And that's not the only thing that could actually impact as a strategic risk. It could also show a relationship to change as well. So for example, when there is a change in company or when the board members are being changed, at that time also a company can go through strategic risk because there is no proper board to make strategic decisions about certain business actions. And there could be yet another factor, that is consequence of unsuccessful ventures. Now, if the big investment doesn't work out, the company usually has to take a major loss. This means they have to say, okay, we lost a lot of money on this, and it also damaged our company's reputation among investors because they might think twice about trusting the company's future plans. Now, if I were to give you an example again, then let's say that a tech company has decided to invest heavily in developing a new innovative product. The success of this product is uncertain because it's something entirely new and the market reaction is unknown. If the product doesn't take off as expected, the company might have to write off a significant amount and investors might lose confidence in company's strategic decisions. In simpler terms, strategic risk is like playing a big game with a lot of money on the line and you're not sure if your moves will pay off or not. If things don't go well, it not only hurts the company's financials, but also damages its reputation among the investor crowd. So this could be a detrimental risk factor for business again. Now let us move to the next slide and talk about reputational risk. So till the time we have come across reputational risk many a times, right? So basically guys, there are two categories of reputational risk. First one is an organization may and will keep its obligation to creditors and counterparties. And second one is the company deals fairly and upholds moral standards. So let us address this first keeping obligations challenge. So one aspect for reputational risk is about whether the company keeps its promises to creditors and counterparties. It's like making sure the company does what it says, and if it does not, then of course that will become a reputational hazard. So for example, let's say a company has released a new product and it turned out to be turmoil or it started bursting out. In that cases, company will try to say that we will provide you with another devices for same. Or for example, let's say a company launched a product where they went heavy losses, but they make sure that investors get their invested amount back. And if they fail to do so, then in that case, a reputational case may arise. And another one is moral standards. Moral standards are basically how company conducts itself. It's about dealing fairly with everyone involved and sticking to moral standards. It's not just about numbers, it's about how the company behaves and treats the people. Is company treating their employees all right? Is company fairly addressing customer problems? If these things are not proper, in that case also a business could go through a reputational risk. All right. Now, if I were to give you an example of this, then I'll refer to something called as accounting scandals. Now, consider a situation where a large corporation is involved in accounting scandal. They manipulate financial numbers to look better than they actually are. When this deception comes to light, it damages the company's reputation significantly. Shareholders, bondholders, and employees lose trust because the company didn't uphold its moral standards, creating a big reputational hazard. In simple terms, reputational risk is like safeguarding a company's good name, and it involves keeping promises to financial partner and also ensuring fair dealing and moral behavior with the customers and staff itself. I hope this is clear to all of you guys. Now let us understand what exactly system risk is in very simple terms. So guys, a systemic risk is like the danger that comes with a business, industry, bank, or even the entire economy faces a breakdown or collapse. It's a big risk that affects everything. So systemic risk is all about possibility of everything falling apart, whether it's a single business, an entire sector, a bank, or even the whole economy. This kind of risk becomes significant when the people providing money like depositors and investors lose trust in the people or institutions using that money, like banks and borrowers. It's like when everyone starts doubting if the system is reliable, and this can happen with different forms of money, like the US dollar or Japanese yen, right? And if we talk about capitalist system, systemic risk cannot be avoided because it is inevitable in a capitalist system. And this risk spreads via a transmission mechanism from ill institutions to comparatively healthier organizations. And this is the most crucial aspect of systemic risk. So guys, from this you can understand that systemic risk is going to be on a larger scale. So for example, once people start losing faith in financial system, banks and governments, everything can go into a turmoil, be it a business, be it a bank, or be it an economy itself. So in those cases, systemic risk can be a very difficult, and it can have a domino effect over everything, right? Now let us move on to the ninth risk, that is operational risk. So guys, operational risk is like danger that comes from various weaknesses in how a business operates. It involves potential losses due to operational problems. Now, the key aspects that can cause operational risk are inadequate systems, management failures, faulty controls, frauds, and human errors. So, inadequate systems basically include risks that come from systems that are not up to the mark. It's like using tools that are not efficient or effective, leading to potential losses. Then there is management failure. When the people in charge don't do their job well, it poses a risk. This could be a decision making, planning, or execution. If management fails, definitely the whole organization is going to fail. Then there is faulty controls. Operational risk involves the danger of having controls that don't work properly. It's like having safety measures in place that fail when needed, leading to potential problems. Then fourth one is fraud. Fraud is another important aspect of operational risk. When people within the business engage in deceitful activities, it can cause financial losses which cannot be recovered, right? And the fifth one is human error. The mistakes made by people working in the business contribute to operational risk. For example, a simple employee logs his email account onto his personal system, and at that time, a cyber threat comes into action, and a lot of companies' data has been lost to a cyber attack. In that case, this is an example of human error in operational risk. All right. In the banking industry, operational risk expands to include two more factors. That is natural and man-made catastrophes and non-financial risk. Natural and man-made catastrophes involves the risk arising from natural disasters like earthquakes or man-made events such as industrial accidents. These events can disrupt operations and cause financial losses. An example of this could be a gas leak that happened in Bhopal back in 90s, right? So when this gas leak happened, this was a man-made catastrophe that led to a substantial economic downfall across the whole India, and a lot of people lost their lives as well. And the businesses or the financial systems that were set out in Bhopal went through a financial turmoil, right? Now, the another reason that could contribute to banking segment when it comes to operational risk is non-financial risk. So these kind of risk include reputational damage or regulatory issue that don't directly involve money, but still pose a threat. In simple term, operational risk is like danger coming from how business operates. It covers potential losses due to inadequate systems, management failures, quality controls, fraud, and human errors, and as well as some catastrophes that has been created by natural calamity or man-made catastrophes, and non-financial risk as well, where the reputation comes into play. Now, let us talk about some factors that lead to operational risk, right? So guys, there are three main factors that lead operational risk. First one is the increasing complexity of financial instruments. And the second one is greater dependency on information system. Third one is lack of familiarity with the new financial instruments. So first, let us talk about increasing complexity of financial instruments. So day by day, financial instruments are growing in complexity, right? And as financial tools become more intricate, understanding and managing the associated risk becomes challenging. Another reason is institutions increasingly rely on information systems for their operations. Now, this dependence creates a vulnerability as any failure or breach in the system can disrupt their complete operations. So, somewhere the reliance on technology itself can cause operational risk. And the third one is lack of familiarity with new financial instruments. So as new financial instruments emerge in the market, there might be a lack of familiarity among institutions. This unfamiliarity can lead to mismanagement and operational issues, and it's akin to navigating through uncharted territory without a clear understanding of the terrain, right? So basically, these are the risks. Now, let us talk about few more factors that can cause operational risk. Now, the fourth factor is misuse of financial instruments. So if financial tools are misused, it can lead to operational issue. It's like having tools that can be helpful if used correctly, but can cause problems if misplaced. Now, fifth one is mispricing or ineffective hedging. Errors in pricing or hedging financial instruments contribute to operational risk. And it's like miscalculating the value or protection of these tools provide. Now, the sixth one is operational error in data feeds. So if there is some sort of small mistake in data feed, the information flowing into system can lead to operational challenge. And if information system fails, in that case, your company or your business could go through a turmoil of a operational risk, right? And according to Basel II, banks should obligate and set aside specific risk capital for these kind of risk. I mean, Basel Accord, a rule book came into a place which is a regulation over banks and financial systems. It says that banks should set aside some sort of capital with them to deal with this kind of operational risks.
Just a quick info, guys. Intellipaat offers advanced certification in investment banking operations in collaboration with Electronics and ICT Academy, IIT Guwahati. Through this course, you'll learn skills like stock borrow lending, risk management, trade life cycle, asset management, etc. via real-time case studies. All of these financial concepts will be covered by esteemed IIT Guwahati faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given in the description below. Without a doubt, this course can set your career to new heights. So visit the course page link given below in the description and take a first step towards career growth in the lucrative field of investment banking.